Hello and welcome back. In this video and the next one we're going to look at the discounted free cash flow model. In the previous video we valued stock by discounting the future dividends, and what it means is that we obtain a market value of the equity of a firm. And that's also what we're going to do in these two videos, but in a different way. So we're first going to look at how to compute the free cash flow of a firm in this one, and when we do that we're going to have some review of some accounting terms that might be needed. And then we will use the free cash flow of the firm to estimate the enterprise value, which is the entire value of a firm. And then through that obtain the market value of equity. So just a small repetition of the last video. Then we had dividends for several years, and we could take, for example, the first one. We discount it to today, and we take the second one, and we discount it until today. We take the third one, discount it till today, so on. And then after some point we said that there should be a constant growth forever, and we value that with the growing perpetuity formula, and then until today. And what I would like to emphasize here is that assumption that it grows forever and exists forever, it was used in that model that I showed in that video. Of course, if we know that the company is going to exist only for 20 years and cease to exist after that, well, then we only compute the present value of the dividends for those first 20 years. So it doesn't have to be forever. Yes, it's always the discounted value of all future dividends, no matter how long. Okay, so this time we're going to look at an annual report to start with. So this is an annual report from H&M for 2013. And we start by focusing here on different profit terms. So we have something called gross profit, we have something called operating profit, we have something called profit after financial items, and then, at the end, profit for the year. So basically these are the four profit measures used by H&M, and they are fairly common, I think. So gross profit is like when you take the revenues and then you exclude all costs which were used to receive that revenue. Then you have the operating profit, you subtract some other stuff, probably all other things associated with the operation. And then you have profit after financial items. So for example, if you receive interest of some money you have in a bank account, or if you pay interest on loans, then that would be a financial item. So you subtract this first, and then you pay the tax, and you get the profit for the year. But we're going to use some other profit measures as well, which are also fairly common. So we are going to use E as a short for earnings, and this will then be the final step. We have EBIT, which stands for earnings before interest and taxes. So the E would be earnings before interest and taxes. And we're also going to use EBITDA, and then this would be the same, so it's earnings before interest and taxes. So it's EBIT plus then the D and the A, which stands for depreciation and amortization. So basically this is like different places in the annual report where you would find this. So this was the annual report for H&M. Then we said that we had earnings that corresponds to the profit for the year in this report. Then we said that we should have something called EBIT, and that was before interest and taxes. If we go back, then EBIT was earnings before interest and taxes. So we need to move, it's before the tax note and it's before the interest income and interest expense. So EBIT in this case would correspond to the operating profit. And then the EBITDA would be plus depreciation and amortization. So it's earnings before interest, taxes, depreciation and amortization. And here you can't really see the depreciation and amortization in this annual report, but it would be somewhere above EBIT anyway. So a little bit else about the profit measures. If you have EBITDA and you subtract the depreciation, and it should also say if you subtract the depreciation and amortization, then you come to EBIT. So if you remove this D and the A, then you simply get to whatever you get if you remove them, which is EBIT. So if you know the depreciation and you subtract it from EBITDA, then you would reach EBIT eventually. In many examples we're not going to see the interest expense or the interest income, and if we don't, then the earnings for the company would be EBIT times 1 minus the tax rate. So T here is the tax rate. Okay, so this is just if you don't have interest expense, or if you don't have it, then this would be the earnings, and also otherwise this is a very important thing to use. But first we need to take some more of the accounting terminology before we can get started. Okay, so when you buy, let's say you buy a car, you buy it for 400,000 Swedish kronor, and then you use it for several years. What's going to happen with it? Well, first of all, it's going to get old, so people won't pay as much for an old car. But also, since you use it, it's going to be used up. I mean, it loses its quality. So you can say that the original value, the value you purchase it for, it can decrease because you wear and tear it. And also, the value might decrease simply because as it ages, it loses its usefulness. So if you think of a computer, if you buy a computer today, even if you won't use it, in 5 years' time, it's not going to be worth as much because the computers you can purchase then for the same amount of money are going to be a lot better because they're getting so much better very fast. So the value could decrease also for something like that. In accounting, the term used to indicate how much that has been used up of an original value is called depreciation. So depreciation is a way of subtracting some value each year and show that the value decreases over time. And then we said that it was depreciation and amortization. They are basically the same thing. So depreciation and amortization both reflect like a loss of value, but they are used for different kinds of assets. So depreciation is used for tangible assets and amortization is used for intangible assets. Well, maybe now you wonder what is a tangible asset and what's an intangible asset. So a tangible asset would be something physical, like property or plant or equipment. Like if you buy a car, that's a tangible asset, you can touch it. Intangible asset, on the other hand, it has no physical existence, but it could be, for example, patents or copyrights or goodwill. So if you buy the right to sell something, I mean, you can't touch that right, but it's still very valuable because you are the only one allowed to sell, for example, a medical drug. So they can still be very valuable, but they are not physically existent. So you define this as tangible asset for physical assets and intangible assets for the no physical existent assets. Okay, so where would we find depreciation then? Well, this is then an annual report, and depreciation would show up in the income statement. And what's important for us is how does this affect cash flow? Okay, so what we see here is that depreciation, it reduces earnings. So you account for it as a cost. But in fact, I mean, it was an accounting term for saying that the value has decreased. So there's no actual cash outflow. So there's no cash outflow. Okay, so what does that mean? Well, we see it as a loss, but it's a loss that doesn't require us to pay any money. So depreciation affects earnings. It's the accounting way of accounting for costs from wear and tear of assets. But it's not a cash payment. So if you would simply look at the earnings of the company, then you would think that the cash flow is too low because in the cost you have depreciation, which is then accounted for as a cost, but it's not actually a payment. So we need to account for that later. Okay, some more terminology then. Well, when a firm delivers a good or service to a customer, then they don't always force the customers to pay upfront, so you don't have to pay immediately. But instead, maybe you send them an invoice and say, well, you can pay in 30 days or 90 days or so. And the total amount that is billed to customers and not yet paid is called trade receivables. Okay, so money that we have not yet received, but that we should receive because we've done something for them, it's called trade receivables. And in the other way around, we could also have the same. We maybe received some goods from another firm, and we have not yet paid to them. Then that would be called trade payables. And here I also want to say there are a lot of accounting terms which mean basically the same thing. This could be account receivables or account payables instead of trade receivables and trade payables. So there are many names for the same thing. And then we're also going to look at what is called inventory. So inventory refers to goods that are stored. Okay, so let's say that we purchase a lot of wood and we keep it in a storage room. That would be classified as inventory. Or it could also be clothing in a store which has not yet been sold. That would also be inventory. So what we've done then is that basically we paid for something that we hope will give us revenue in the future, but at the moment it's just lying there as an asset and we can't really get that money. Okay, so where do we find this then in an annual report? Well, the inventory is found in the balance sheet, the trade receivables is found in the balance sheet, and the trade payables is found in the balance sheet. So let's focus first on inventory. If inventory decreases from 500 this year to 300 next year, what does that mean for our cash flow? Well, as I said, inventory was things that were stuck. Well, it's money stuck in goods. So if the inventory decreases from 500 to 300, it basically means that cash flow is released, or sorry, cash is released, because it used to be stuck in inventory and now it's suddenly not. The same thing about trade receivables. So this is money that we are awaiting to receive. So if this increase from 900 to 1050, it means that now we're suddenly waiting for more money than we were last year. So we've done stuff, maybe more than last year, and some of that has not yet been repaid. And here we see that it's been an increase in the money that we're waiting to receive. And what about trade payables then? Well, here trade payables increased from 1,100 to 1,240. It means that we used to owe people 1,100 and now we owe them even more. So there's more money that we should have paid that we've not yet paid. And what would be the effect on our cash then? Well, it means that we have more cash at our hands since we have not yet paid it to someone else. Okay, so we're going to clump all of these together because it's messy to keep track of everything. So we use a term called net working capital or just working capital. And it will describe basically how much we have stuck in, for example, inventory or trade payables. So this could be negative. I mean, if we owe people a lot of money, but we have no inventory and no one owes us any money, then the net working capital would be negative because we have nothing that's going to give us money soon, but we owe a lot of people money. But usually when we do examples here, it's going to be positive. And an increase in net working capital, that would mean that we have more money stuck in, for example, inventory. So since there's more money which is stuck, it would affect the cash flow negatively. So an increase in working capital affects the cash flow negatively. A decrease in net working capital for the same reason would release cash that were previously stuck, and a decrease would therefore affect the cash flow positively. Okay, some more terminology then, of course. When you run a business, then to maintain your operations and possibly even expand, you need to upgrade or replace some of the old machinery. So eventually your car will stop working and then you either need to repair it, which could be seen as an upgrade, or you need to replace it with something else. So if you want to do the same thing or even more, then you eventually will need to buy more or at least replace it. And when you pay money for this kind of outlay, it's called a capital expenditure. Okay, so what happens then? Do you see this on the income statement? Well, no, because when you buy, for example, a machine, then it will be registered in the balance sheet. So here we can see that the machines has increased in value from 4,000 to 4,500. So you could think that the capital expenditure would be equal to 4,500 minus the previous value. So it's an increase by 500. But this is a little bit too simple because remember depreciation. This was the accounting way of saying that the old machinery we had has lost value. So the old machine lost value with 1,500, and even though it lost value, we have still increased the book value of the machines. So we went from 4,000 to 4,500, despite a loss in the old value of 1,500. So the capital expenditure is in fact this amount. So you add back the depreciation if you want to see, you see how much was the net change, and then you need to account for the fact that depreciation reduced the value here. So in this case, capital expenditure must have been a total of 2,000. So you increase the value of machines by 2,000, then it decreased by 1,500. The net increase would be 500, as we see here. Okay, so what does this mean then? Well, capital expenditures does not affect earnings immediately. It's instead affecting earnings when you depreciate it. But you do have to pay. I mean, if you buy a new machine, you pay for the new machine. So for that reason, it affects the cash flow of the firm. Okay, so how do we compute the free cash flow then? Well, we're going to start from EBIT times 1 minus tax, which could more or less be seen as the earnings of the company. Then you add back depreciation. Why do you do that? Well, depreciation was an expense, but it was not a cash outflow, so we need to put it back in the cash flow. Then you subtract capital expenditures. So these two are like complete opposite, because capital expenditures is a money outlay, but it does not affect earnings. So if you just look at the earnings term, then we see nothing from capital expenditures. And finally, we should subtract any increase in net working capital. If net working capital would decrease, we would then have a positive effect on free cash flow. So to put it as a formula, if you want to say that, then you start by, so FCF, you start from EBIT times 1 minus the tax. Then you add back depreciation. You subtract capital expenditure. And you subtract any increase in working capital. So this is a short way of writing. This delta here stands for increase and working capital. And maybe a more normal word for capital expenditure could be investments, if you want to think of it in that way instead. So this is how we find the free cash flow of a firm for a single year. And in the next video, we're going to use that to find the value of a firm. Thank you very much.